The greatest concerns are very thin levels of capital. We call it surplus in the insurance industry. We also have some very high-risk assets that have been introduced. Can't get a good market quote on a lot of it. We now have several $1 trillion worth of reinsurance. I can't see the other end of the transaction. We have a mismatch between assets and liabilities. The problem is the industry has begun borrowing short-term a lot. It's skyrocketed in the last 3 years. So you've got companies, they have $64 billion of money that has been borrowed short-term. And if those institutional investors decide they want their money back, and we know what that spells.
You've looked at more independent insurance companies' books than any other human. You've put more people behind bars for insurance-related fraud than anyone else. People are starting to say, Gober, you're right.
I worked undercover for 2.5 years. It's a very intense period of my life, I have to say. I carried a briefcase that had a Velcro section you could pull away, and in it was a Swiss-made reel-to-reel stereo recording device. And when I was in meetings with executives and they were lying to me, and I knew they were trying to pressure me to not disclose the truth, I recorded it. 12 years of me helping the FBI and the U.S. Attorney's Office on a series of big criminal cases involving reinsurance. The reinsurance wasn't real.
Tom Gober, welcome to the show.
Delighted to be here, and it is truly a privilege. You do a good thing. I wish more advisors looked to the truth more than the greatest commissions.
Yeah, we had dinner last night at our home. Thank you so much for coming to Nashville.
Great.
And I've had a couple conversations with you, and I think it's fair to say that you've looked at more independent insurance companies' books than any other human. And a fun fact, you've put more people behind bars for insurance-related fraud, maybe even more people behind bars for white-collar fraud than anyone else. And I'm excited to dive into that story.
Yep.
You've said a couple times that people are starting to listen and people are starting to say, Gober, you're right, or you've been right. What are they referencing about you being right about?
The big issues, my greatest concerns, the things that I've been watching beginning 41 years ago as a young examiner. I learned how companies are supposed to report, and it's supposed to be truthful, and it's supposed to be transparent. And over the last 4 decades, it has headed the wrong direction. The greatest concerns are very thin levels of capital. We call it surplus in the insurance industry. Surplus is that only buffer above all your promises. So assets minus liabilities equals surplus. That's your buffer, and it's the only amount between an insolvent company and a solvent company. So that buffer, the NAIC wants it to be comfortable. The industry should have a buffer that can handle write-downs in these risky times, right? So thin levels of surplus is my first concern. We also have some very high-risk assets that have been introduced. They've been doing it for a while, but it's caught more attention lately. Private credit, private equity. My biggest concern is that a lot of them are assets that don't have a good market. You can't get a good market quote on a lot of it. So we don't know how quickly they could be sold to pay claims. Another issue is what they call offshore reinsurance and captive reinsurance. We'll talk about what reinsurance is, but it's laying off of risk is what they're supposed to be doing.
Mm-hmm.
That's supposed to be transparent. And we now have several $1 trillion worth of reinsurance that I can't see the other end of the transaction. And then finally, we have a mismatch between assets and liabilities. And the industry is quick. In fact, in the Financial Times just yesterday, the industry said, well, these are long-term liabilities. life insurance, those will be paid many decades down the road. So it's okay to have longer term, less liquid paper. Problem is the industry has begun borrowing short term a lot. It's skyrocketed in the last 3 years. So you've got companies, one will show you here in a few minutes. They have 64 billion of money that has been borrowed short term. And if those institutional investors decide they want their money back, suddenly those long-term illiquid investments might need to be sold in a hurry, and
Mhm.
we know what that spells.
Yeah.
Those are the main points, and those are the things I've really been screaming about for a long time.
Yeah.
But now they're saying, "Gosh, I guess Gober was right."
In having conversations with you, I'm realizing that the lack of transparency is probably the biggest trigger for you. You're like, "Hey,
No
it's
doubt.
if we can't see because you've and we're gonna dive in whether it's on this episode or another episode. I can throw any company at you, and you essentially have all their documents,
I do.
and it's amazing. I've never met someone like you that has done that type of research. But the reality is, if you can't see the other end, you have no idea.
No idea.
And in the past, when there have been things exposed or leaked, you've they've been less than good. Is that a fair thing to say?
Worse than that,
Yeah.
but been substantially underfunded. Big black hole hiding where we can't see it.
So there's a lot of conversations about private credit. And while that's going to be part of our conversation, in having conversations with you, I've realized that this idea of reinsurance and I want you to explain traditional, like what reinsurance should be because it's a good thing.
Mhm.
But it's my understanding that a lot of these companies are using reinsurance as a way to, and I'm using your example of like taking files from upstairs, bringing it down in the basement, still your
Still your
liability,
claims.
but somehow magically, because it's a reinsurance company,
Mhm.
it's off your books. But the crazy thing is, they own that reinsurance company
100%.
100%. And if it's overseas, they don't have to report on it. And I'm here thinking I'm not that bright, but I'm like, how in the world is that even legal? It seems like if I give you the benefit of the doubt, I'm trying to figure out why someone would do that in the right mind, but it's so easy for the wrong person to cook the books in a legal way. So then break down reinsurance and break down how reinsurance works and then the real thesis around that, and then we'll get into your backstory.
Sure. You started by saying reinsurance can be a good thing, and I wanna back up and say insurance, life insurance, annuities are really important. I've focused on that industry for 41 years. We need the ability to purchase those long-term promises and be able to count on the company living longer than your loved one, right? Reinsurance is also an excellent thing if done properly. It enables a company to share some of the risk with another independent party. Reinsurance has been my primary focus for 41 years. I have to tell you, in the early years, they ceded or transferred reinsurance to real reinsurance companies
Yep.
that were unaffiliated, that not only were willing to take the risks, but had the money to honor the payments.
Yeah. So just to break that down, you're an insurance company. I'm a reinsurance company.
Got it.
You're getting business,
Mhm.
and then you come knocking on my door and say, "Hey, Caleb, I have some risk that it's too concentrated maybe, and so I
But
want to sell you
mhm.
the risk." And so I'm giving you. Talk to me about how that transaction
Sure,
works.
and it's not really sell it. What you do is, let's use an even 10 billion.
Okay.
Let's say there is a large block of life insurance business or annuities, and it totals to 10 billion is what has to be set aside at year end at midnight. The actuary says you have to have 10 billion. You can look to a real reinsurance company and say, "Hey, why don't we do an 80-20 coinsurance, which means we keep 80% of the 10 billion, but the reinsurer says, "Yeah, we'll take that 2 billion." So it's a sharing of risks over time. With an independent party, they're sophisticated.
Right.
Reinsurance companies know more than insurance companies because they see
Everyone.
everybody's
Yes.
books, right? So you look to an outside reinsurer as a strategic partner,
Mhm.
right? Wisdom, prudence,
And insurance company, I mean, one of the definitions of insurance is pooling risk.
no doubt about
And
it.
so even insurance companies that have a lot more money than we do are doing that in layers as well. So,
Yep. And legitimate reinsurance is a great thing. It
right.
makes the world go round, frankly.
Okay.
But over the last several decades, there has been a dramatic migration away from independent reinsurance to reportedly transferring the liabilities from the main insurer to someone else. And unfortunately, that someone else is an affiliate or even a direct subsidiary of the insurance company. So you're not going to an outside independent reinsurer that knows what they're doing. You're going to a sister. You're moving liabilities from one pocket to another, or like I say, you get a box of claim files from the file room and move them down to the basement. I don't see them doing much more than that in these
They're
transactions.
still holding the risk,
Exactly.
but why are they incentivized to do that? I think you broke this down to me a few times
Mhm.
around like I think it starts with maybe good intentions. I don't think people are trying to do something dirty, but then you get yourself in a potential problem. Talk to me about how, the CFO or CEO could get themselves in a situation like this.
Sure. So let's use the $10 billion example again. Let's say that I ask the reinsurer, would you take on the entire block, not 80/20? Would you take this block of 10 billion in obligations so that I'm no longer having to report those liabilities on my balance sheet because you're setting them up? And to be fair, if it's a real transaction and you're going to an independent reinsurer that has its own money, it would be unfair to make both companies keep 10 billion up.
Mhm.
So you subtract 10 here, you set up 10 there. But here's the trick. In a real transaction, those are real liabilities. At midnight, that 10 billion is already the calculation of present value. That's not how much they're going to pay decades into the future. That's what we have to have right now. So when I ask independent Swiss reinsurer, would you take this 10 billion? They're going to say, yeah, if you'll send us 10 billion in assets. Now they might take 9.93 billion, but it has to be commensurate.
Yes.
Needs to be fair and reasonable. And
Yes.
it's real liabilities, so they're going to want real assets, right?
Yes.
If you do that with an independent party, they're going to expect an arm's length transaction. But when the same executive controls the insurance company and this little secret reinsurer in the Caymans, he can say, I want to move 10 billion in real liabilities to you, but I'm only going to send you 7 billion in assets. Well, what's he going to say to himself? Hey, great idea,
Yeah.
right?
Yeah.
A real reinsurer would say, no way, but he says to himself, yeah, great idea, let's do it. That moment, you create 3 billion in fake surplus. You subtract 10 billion in liabilities, but you only subtract 7 billion in assets. Surplus, poof, jumps up by 3 billion. They usually would do that in a much smaller amount early on. They might do something where they pick up an extra 100 million. But the next year end, the CFO says, we didn't gain enough surplus to justify paying a stockholder dividend. And we want to be able to pay those dividends. So all they have to do is literally take the contract they already have, change the dates, the dollar amounts, and poof, here's another 400 million this time. And I can show you
Yes.
these companies have gone from small amounts to skyrocketing amounts in a short period of
Yep.
time.
I asked you because I'm more aware of lawsuits now, for better or worse, and I asked you, "Are you afraid to get sued?"
I'm not. I've never been sued. No one's ever threatened. And I believe it's because they know that I know a lot more about what they're doing under the table than I'm even talking about.
Yep.
So they would open a can of worms. But that's
And
fine.
you're using their numbers and their reports.
Excellent point. I want it to be crystal clear. We're going to show you some numbers here in a little bit. Every dollar amount I use is straight from their own sworn statutory annual statement under penalty of perjury.
Yep.
So I'm using their numbers. I'm just calling attention to certain things people need to be aware of.
Yep. Uh, we're also, whether it's on this episode or a future, we're gonna go through the top insurance companies on the annuity side and life insurance side, and you're gonna give me, like, a quick overview in your reports.
Great.
When people hear this, obviously, I just wanna address this. Not all companies are created equal. There's some traditional mutual companies that have massive surpluses, and then there's some companies that are not that don't have very much surpluses, might be stock companies, might be private equity owned. Before we get into your backstory, can you just like share big picture, like the different type of insurance companies and just clarify for yourself,
Excellent.
not all of them are created equal.
Great point. There are two categories of life insurance companies that exist entirely for their own policyholders. There's fraternals, and they tend to be smaller.
Mhm.
And if you're a fraternal insurance company, your members pay in premiums, but they're also owners of the company, right? There are no outside investors. Mutuals tend to be larger. Some of them are huge.
Yep.
Some of them are extremely well run. They tend to have very large surplus levels because they don't have an outside investor saying, hey, when are you going to send me some money? Because when you start paying money out, uh, let me say it this way. With a mutual insurance company, you've got a pot. Premiums go into the pot, claims go out. And all companies have expenses to run it, administrative, but those tend to be very measured in mutual companies. So you got premiums coming in, claims going out. If you make a lot of money over several years, they take that money and give it back one way or another, either in policyholder dividends, premium rebates or refunds, because it self-balances. Same thing if you had more claims than premiums
Yep.
over a period, you have to go to your members and say, hey, we had higher claims than we anticipated, so we're going to go up on your premiums a bit. But when that happens, you know exactly why.
Right.
But
And it's fair to say mutual companies, obviously, like, the only way to be an owner is to be a policyholder,
exactly.
and fraternal companies, you're a member,
Mhm.
and so there seems to be right incentive. It's executives running a company and the profits, the surplus go
To the people who
to the
pay the
people.
premiums, it is always fair because you're simply handling
Right.
a service for these people. Once it goes, if they demutualize, and that's
Yes.
something we should talk
Yeah,
about.
demutualization, and then there's straight up stock companies
Exactly.
that feel like, from my point of view, that have more of a conflict of interest.
Yes, indeed. So what you have is the mutuals and the fraternals, because they exist for their policyholders, there's no incentive to inflate your financial appearance. But once you demutualize, if you become a for-profit company, investors begin right away. They want a return. And if you go back and look at Metropolitan Life, Prudential, when they demutualized, you can pull up the stock dividend history chart and you'll see every year. It not only gets paid every year, it goes up every year. Except for that 2008 hiccup, it stayed the same. But so the trajectory of money out gets higher every year. So think about that. If you have a bad year, and all companies, even the best companies, have years where they lose, under the statutory accounting rules, the insurance commissioners are not supposed to let them pay a stockholder dividend if they're losing money or their surplus is too thin for obvious reasons, right? So if that happens and the CEO asks the CFO, we're getting close to Christmas, and he says, are we going to be able to pay that dividend? I'm sorry, we're 300 million short. They either browbeat the actuary to go back and come up with a lower reserve liability number, or they just do another non-arm's length, non-fair and reasonable transaction that creates fluff. I call it fake surplus. They fluff up their surplus in appearance only.
Yeah, and it's an equivalent. You use this example before recording of if I have a mortgage and I want to get more debt, but let's say the bank is like, "Hey,
you already owe us
you already
$300,000.
you already owe us enough money," and then I go and sell my debt to my daughter, and then I
Who's
go
2 years old.
2 years old, and I go to the bank and say, "Well, not now. I don't no longer
Someone
have that
else
debt."
is on the hook.
And then they just give me an extra debt. That's an equivalent, and the people that are really get the short end of the stick if this all comes down are the people that are the clients, are the people that are
No doubt
pension
about
I mean, these insurance companies are some of the largest holders of pension funds,
No doubt.
annuities, and insurance claims, and these are not short-term promises. These are long-term promises.
Very long-term promises.
And so it's almost like you're playing a short-term game, and you're creating short-term incentives for something that you need to be around 100 years from now, plus.
Right. That's such an important point, because what I often say to advisors, even if you have the perfect life insurance product or annuity, it's designed just right for your customer. What good is it if the insurance company dies before your client does?
I agree.
It suddenly goes from a great product to a worthless product.
Right.
And that's a huge problem.
And I want to ask two other things, and we're going to get into your backstory, because I really believe that there's going to be a movie made from you, and I really believe
exciting,
that.
I have to say.
I would love to see that happen, and I also wouldn't, because that probably means that some of the things that you're claiming is going to happen are going to happen, and it's going to be like a 2008 deal. So I hope that movie's never going to happen, but I tend to believe you, and that's why you're sitting here, and that's why we're talking. Let's first talk about the incentive. Obviously, there is a greater incentive for stock companies, but let's be clear. I think all executives have incentives, and even in the mutual companies, they get paid quite well running mutual companies. And so that's why there needs to be checks and balances across the board, is to say, hey, even if you're a mutual company, just because you're mutual doesn't mean we can't challenge or look at you. So that's number one. And then the second thing is, when one of these companies go down, and there have been some in the past, but if some of these bigger companies start to go down or fail, it's going to affect everybody.
Yep.
It's going to affect everybody. What is the effect going to be if one of these massive companies, because it's my understanding that if your surplus is zero, you're already in receivership.
You're not allowed to even get to zero. According to the statutory accounting guidelines, we make sure that if they report truthfully, if they get below the minimum, and let's say on a given company, their calculation says we can't get below 100 million. If they get to 99,990,000, they're just a dollar short. The statutes require the regulator to come in, put his arms around everything, and protect those assets for the policyholders. So that event puts things on hold. It's like a freeze. And I've helped. Some of the most meaningful work I've ever done has been on receiverships. I go in on day one when the marshal has to come in and lock the door. We have to pick up all the thumb drives, laptops, servers, files, and protect everything and determine what is the balance sheet really worth? Are these assets reported truthfully? And can we collect this reinsurance that we claim that we can? Unfortunately, when I've gone in often, there is a big hole. And people say, how could there be that big a hole? You're supposed to catch it when they get
Yeah,
close to
it
zero.
should be a 0.
In fact, if it's properly done and there's transparency, we would never have a policyholder lose money. But unfortunately, what I find is one company I did the receivership work on in Virginia, they reported a positive 40 million in surplus. Now, that's not a lot of surplus, but it's a positive number.
Yeah.
The same as of date, we found them 490 million below zero. How do you go from a positive 40 to a negative 490? And there's only one way. You pretend you got rid of liabilities through reinsurance, and really you didn't get rid of the liabilities. So the regulator gets in and goes, oh my gosh, how could it be this bad? Well, you thought the reinsurer was truly on the hook, and they're not. So remember, the insurance company has to pay your claim. Even if they've reinsured it, when the claim comes in, they have to pay it. Then they can get reimbursed by the reinsurer. But what if you find out the reinsurer is a sham? Those liabilities all of a sudden have to come back onto the balance sheet. And so the big black hole grows
Yep.
over time.
All right, let's get in your story. You didn't come out of the womb saying, "You know what? I wanna look at insurance companies' books." How did you get into this? And then how did you get into getting people thrown in jail? And because you actually worked undercover.
Mhm.
And so I wanna let you hear the story, and I just wanna share this before we get in. Um, someone asked, my wife, because we had dinner last night, they're like, "How was the conversation with Tom Gober? And, like, what do you guys talk about?" And she thought you were the coolest person. And it was fun to listen to her because she said nothing about the reinsurance or any of that. She's like, "Yeah, Tom goes undercover and busts people and throws them in jail." And I was like, "Well, that is true, and it is funny how that's her big takeaway from our conversation."
Well, it's a real important message. People went to jail for a real reason. I'm not a goody-goody. I don't expect everybody to do everything properly all the time. But when you make really long-term promises, your books are supposed to be true and transparent. And as long as that's the case, everything's fine. But in these criminal cases that I worked, these were men who were already wealthy who wanted more. And they would use a fake reinsurance transaction to create an appearance of surplus. And then they would wire that money to one shell company, then on to another shell company, and ultimately it would buy a home in Del Mar, California, or a case of wine for $18,000 purchased from Sotheby's. So I helped trace that money. I helped show that they used false accounting entries to hide the fact that they were using policyholder premiums and reserve liabilities to buy nice things for themselves.
Yep.
They went to prison for that reason. And yeah, I worked undercover for 2.5 years. It was a very intense period of my life, I have to say.
But how did you get into that? You shared a story on how when you first, I think the first time you discovered these shenanigans, how many years ago was that? You were working with the Mississippi Insurance
Department of
Commissioner.
Insurance,
So
that's
why don't
right.
you break down, like, how you got involved in that and share the story? I
Sure.
because in all the interviews I've heard, you've not actually unpacked your story, and I would love to be the first to capture that.
While I was learning to be an examiner, you have to have 2 years of on-site examinations with a mentor who's a CFE and pass 7 exams. and then you have to do another 2 years to get certified under a mentor, and another 5 exams. During that time, I noticed that I was only being sent to examine the clean companies. But the day I got my CFE, the gentleman who was a CFE that had trained me, my mentor, immediately said, "Tom, I wish you the best. I'm out of here."
And
And
what
I
is
said,
CFE?
certified
Certified
financial
so
examiner.
okay,
I'm a CFE today, certified fraud examiner.
okay.
But a certified financial examiner is a required certificate before you can conduct examinations and sign off on the reports. Very serious commitment professionally. So when he left, I was the only CFE at that point. So they had to send me to companies that were cooking the books. I didn't know that, but I learned it soon enough. On one company,
And what year was this when you started?
it was 37 years ago, something like that. It was 4 years into
In the
being an examiner.
1980s.
Yes,
Okay.
yeah, in the 80s. So I began this examination on a company there in Jackson, and I asked for the reinsurance contracts. And the next morning when I came in, we examined them at the corporate office. So I'm in this little room with a table, and there is the stack of reinsurance contracts. I went through them, made the tick marks I needed, checked to make sure it was transferring risk, a lot of things.
And you're there originally because any insurance company has people audit them. And so this company was in the state of Mississippi,
Mhm.
and so you were coming in. Is this an annual thing that happens?
No, it's every 3 years in Mississippi. A
Okay.
lot of states, it's every 4, and some it's even 5.
Okay, so this is every
Long spread out.
and so they are probably dreading any type of examiner coming in to begin
They
with.
yeah,
They
if they're not a good company,
yeah,
yeah,
right.
they hate it.
All right, so you're there, you're asking for the reinsurance documents.
I come in that morning, there's a stack of them, they look nice, leather bound, and I go through them, and I get to the end, and I realize one contract was missing. So I call the CFO just on the local phone, and I said, "Hey, I asked for all the contracts. You brought me 10, but there's 11. I'm missing one, and I need to review it." And he got nervous, and he said, "Which one is that?" And I told him. He said, I don't know anything about that contract. You're going to have to ask our actuary." So I'm thinking, that's odd. Why didn't they bring that contract? So I look at the books, their balance sheet, and I realize the company had roughly $2 million in surplus. But this reinsurance contract, if I treated it as legitimate, gave them $5 million. So if I said this is a sham, and it was, you would have to subtract $5 million from the $2 million. So the company's broke.
Yes.
The company's insolvent. So I disclosed all about the contract that I literally read the thing 20 times. It was an obfuscation. You know what I mean?
Yep.
It
You
would
can
run
name
you.
names if you want, but you don't have to name names if you don't want.
I don't think it matters
Okay.
at this point, but we'll get into some names
Okay.
here in a little bit. But so I disclosed it. It's my job. I said the contract doesn't transfer risk, so we have to non-emit the $5 million credit. So when I turned in the report, I expected something to happen because I showed they were below zero. And the laws say they have to take it over, and nothing happened. So I go down to the insurance department. I go into the archives room, and I start going through. There's, hundreds of these exam reports. I find the right one. I pull it down, and I look, and there is my original signature in blue ink. So I knew this was my report. So I go to the middle of the report where there were at least 7 pages describing all this scheme, fake reinsurance scheme. And they had removed all those pages. They had pulled them out and retyped pages. Today it's easy to match font on a computer, but they were typing it. So it didn't even look right, right? And it was a whitewash. They didn't mention any of the fraud that I had disclosed. So I freaked out. My signature was on the report. It had been redacted, and they didn't tell me they had redacted it, and they sent it out all over the country. So I was upset. I mean, I was really upset. I took the report off the shelf, and I went straight to visit my dad. My dad's a brilliant guy, and he's a Methodist minister for 52 years. And I explained what had happened, and he said, "Tom, that's serious business." I said, "Yeah, I know." He called someone that is in his prayer group, and he called him, and he's a lawyer. Called him and said, "Tom's in a spot. Can I send him to you?" So I take the fake, the redacted report, and I go see this lawyer, and he says the same thing my dad said. This is serious business. My worry was they would try to say I should have found, but I knew I had, right? And I had kept the original report
Always keep your
always.
receipts. Yeah.
So this member of a prayer group of my dad's, who's a brilliant lawyer, calls his neighbor, a friend of his, who's the chief of the criminal division of the U.S. Attorney's
Oh
Office
boy. Now we're
in Northern District of Mississippi. And he says, "Send him right over." So in a half hour, here I am at the U.S. Attorney's Office, and he already has his top FBI agent in there. And they asked me all about it, and I showed how they had redacted my report and didn't tell me and sent them out under my signature. So they asked me, "Would you continue to do the exact same thing you're doing now? Be an examiner, do what you're supposed to do, disclose it. But if you encounter something like this, would you document it? Would you be willing to record?" And I thought, that's kind of nerve-wracking, but at least it documents the truth that I'm trying to do, right? And I didn't have that opportunity in this other instance. So for 2.5 years, I carried a briefcase that had a Velcro section you could pull away, and in it was a Swiss-made reel-to-reel stereo recording device. And when I was in meetings with executives and they were lying to me, and I knew they were, and they were trying to pressure me to not disclose the truth, I recorded it. So that led to 12 years of me helping the FBI and the U.S. Attorney's Office on a series of big criminal cases involving reinsurance, where the reinsurance wasn't real, it was fake, right? And so that was 37 years ago, and I screamed about it. We worked criminal cases, people went to jail, but still reinsurance that isn't arm's length, isn't fair and reasonable, is helping inflate surplus beyond what it is truthfully, is rampant.
What was the difference between the people that went to jail and the people that are doing this now?
You just had to ask me that,
I'm
didn't
just I'm curious because you were gonna show later something that you presented to a Senate committee, and it seems like people have gone to jail for a lot less. I'll just put it that way. I said it, not you.
Fair enough. The problem with criminal cases today in the insurance industry is that the industry says, we've gotten approval on this. And that is a problem for the FBI. If a regulator says you can do something, even though you shouldn't be doing it, they claim it creates a real problem for the criminal case. And I understand that totally. The problem is the regulators have been set up in a structure to where a lot of the regulators hold companies to the truth, but some states are especially friendly to the industry. It's what I call a race to the bottom. They want to attract industry, so they tell the companies, we're especially friendly. And they're letting them do things that they know they should not be allowed to do. But I believe there is still room for criminal cases, because even when the commissioner might say you can do this, the commissioner doesn't say, and you can pretend it's worth
No.
$5.25 billion when it's really worth zero.
Yeah.
Right? So they're cooking the books still, but anyway, it's
But they're
complicated.
doing it in a way, and again, this is all alleged because there's some things you cannot see. So there's a world where they're having all these reinsurance that's a subsidiary of them, and they're doing the right thing. Highly unlikely, but what you're saying is that's totally it gets the stamp of approval from whatever the state insurance commissioner is.
Even though it shouldn't get a stamp.
Okay, so let's talk about why are insurance companies regulated at the state level versus federal? You look at just talk about the difference between banking regulation and insurance regulation.
Yeah, it's disappointing to me that there is no federal oversight. There's no federal authority over the insurance companies themselves. The SEC can look at the publicly traded holding companies, but the insurance commissioners, one for each state, is supposed to make sure these companies are reporting truthfully, that they're abiding by all the laws. When certain state regulators begin allowing things to happen that they shouldn't, the problem is they're doing it in places we can't see. So Vermont allows a lot of what they call captive reinsurance companies in Vermont. The statutes actually say that even though these are policyholders of a big company that have to report truthfully and transparently, just by moving the promises to, it's not even a real company, right? It's just it's an SPV. It's a
And
piece of paper,
what is an SPV?
a special purpose vehicle.
Okay.
It's just an alter ego of the company itself. So why does moving those promises from, say, Iowa to Vermont, why does suddenly the regulation become radically less protective of the consumer?
Mhm.
And I have to say it's the same offshore. When you hear about all of this reinsurance in the Caymans, they're not insuring Cayman citizens. These are U.S. citizens.
Yep.
So if the regulators at the state level you asked about, if those regulators are supposed to protect the policyholders in their state, why are they letting them move the promises to pay to an island country where they don't have to report on the annual statements that they should be filing
I
on,
agree.
right? And while I can't tell you how underfunded they are, I can tell you that the few times we've actually been able to peer into that black box, it's been really bad, way underfunded.
Can you give us numbers or ratios?
Yeah, the last opportunity I had was to review 3 Vermont captives that were subsidiaries of an Iowa insurance company. Those 3 captives had about $6 billion they needed to be able to pay back to the company in Iowa. And these are wholly owned subsidiaries, right?
Yeah.
Literally, the company already owns the assets, liabilities, revenues, and expenses of these captives. So how does moving liabilities to them do anything anyway? But instead of funding the $6 billion with $6 billion in real assets, they had less than 300 million in real assets. The rest were plugged with these things called XOL assets.
What are XOL?
It's complicated, but it is the latest thing where an insurance company, if the regulator in Vermont, or there's some other states that do it now, South Carolina, Delaware, Arizona, Iowa. So if those states say it's okay to do it, suddenly the insurance company, in this case, had a $6 billion recoverable from their subsidiaries, but only less than 300 million to cover that. The rest were they're contingent, and it's probably more complicated for this kind of interview, but I'll just say this. They pay pennies on the dollar. They may pay 4 cents for $1 of supposed coverage and simultaneously book it at the dollar. So imagine if you could pay 4 cents for something and immediately book it at $1, we could solve our deficit of the U.S. Just do a bunch of XOLs. It doesn't work. It's not real. It's not an asset. It doesn't meet the definition.
Let's hope no one from the Fed is watching this, because they might get some ideas. Hey, we have a way to get to transfer more of our debt as a country. Do some reinsurance on the debt. I try to play devil's advocate whenever I can to try to create a fair and balanced. So talk to me where I'm going wrong. So I'm an executive of an insurance company. I'm regulated. In any state, there's regulations mainly on how I can invest my assets, because insurance, there's a lot of, I can't just put all that money in the market kind of deal. So there's heavy regulations. And so one could say, well, by me putting money in a captive that I fully control, that's outside the country, allows me to do almost whatever I want with that money. Now, you're looking at this as they could be underfunded. We have no idea what's happening. I'm trying to put myself in the shoes of someone that says, well, I have investments over here, maybe private credit investments that I wouldn't be able to do, or I wouldn't be able to do properly over here, but this gives me a way to funnel money to be able to do maybe higher risk investments. And in their head, they're like, yes, we're underfunding potentially, but these investments are all going to work out, and it's actually going to be better for the insurance company. Is that self-talk that they're saying? Because I really don't believe that there's people, I mean, there's probably are, and you've probably put a lot of people in jail for this, but I do believe there's probably good intentions, and intentions don't really matter anything at all. It's really what's the outcome. But I'm trying to figure out, like, what would be the counter argument to why captives could be a valuable thing to insurance companies.
It's a good question. It's a fair question. The industry that uses these mechanisms say that it is more capital efficient, so that it frees up more money to do things with. And they feel like that gives them a wider set of opportunities
to invest.
Right. And I understand that argument. I only care about one thing. Report your books in accordance with the statutes. That's what they're there for.
Yeah.
So when they do a transaction where they send $10 billion in liabilities, but only $7 billion in assets,
report that.
That $3 billion, you should have to disclose, by the way,
I agree.
This is not arm's length. It created a fake $3 billion, and we're going to use that to do whatever they want to use. The point is, the statutes prohibit it. It's crystal clear in all 51 jurisdictions. Any material transaction between an insurance company and any affiliate, it doesn't say and any affiliate unless they're in the Caymans, with any affiliate, they must be on terms that are fair and reasonable. In other words, that's a technical term of art, that the transaction would be entered into by two independent parties with knowledge of the transaction, right? They come to an agreement, it's arm's length. And as auditors or examiners, when it's truly arm's length with an independent party, you don't have an assumption of lack of fairness or reasonableness. But when a company does a transaction with another of their companies where the same people control both
Yep.
ends, here's the problem. That fluff they create doesn't help the policyholders or the company. It's being used to pay stockholder dividends or to buy a yacht.
But the music's gotta end eventually, and so are executives just hoping that they can get a payday before and leave it with somebody else? Is it like musical chairs where they're like, I don't my and maybe I'm coming from a different intent, but I'm like, what's the exit plan? Do they not care about legacy? Do they not care about are they incentivized to literally like what why do you think there's a reason for
It's a
this?
very fair question, and I can only tell you based on my experience. Most commissioners are in for 4 years and out. A lot of them come from industry to be a commissioner, and when they finish their 4 years, they go back to industry, and they make really good money. While they're commissioner, they may not make that much, but when they finish, they do. So you can
A lot like
imagine,
politicians.
and this is a complex industry. It might take a commissioner 2 years to really grasp what's really happening. And if he finds out, oh God, this company's using a ton of fake reinsurance in Barbados, by the time he realizes it's something that needs to be addressed, he might be thinking, I'm almost done with my 4 years. If I can just, what I call pushing bad news into the future,
Mm.
if I can just put that off a little bit, I can get out and it'll be the next guy's
But then
headache.
what about the executives from the private insurance companies? What's their incentive?
They've gotten what they wanted to get, and when it falls, unfortunately, it's not the holding companies that put money in. They've been taking
Yep.
money out, so hopefully there'll be penalties.
Yep. I know we're gonna do a whole episode on Ohio National, Phoenix Life, but you even look at Ohio National, they were a good
They
company,
were a great company. They
and
were a mutual.
and you look at what happened, they got demutualized, it's been really sad to see what's happened, and you look at the executives, and you can speculate on what they got paid. It was a ton of money, and so and it's just it's frustrating to think, like, how could there be like, you're literally creating an incentive to hurt, and I'm speaking out of my personal opinion,
Mhm,
hurt a massive block of people,
mhm.
policyholders,
Policyholders.
and it just doesn't feel right, and it feels like and other than the Ohio National now being watered down and like, completely stripped of what the company used to
Used to
be,
be.
and but then you look at some of the key executives, and they got paid a lifetime amount of money to make that happen, and you go, like, "What value was created other than their pocketbooks?"
Negative value, and they're paid well because it looks like they've done well. If you take these companies and say, "All this Barbados reinsurance is way underfunded, it's sleight of hand, you're creating fake surplus." If you pull that out, the company looks really bad, and so they would probably not pay them that high amount. So they're being rewarded for basically inflating the true long-term viability of a company, and
Yep,
that's what's painful to me.
yep. Let's name some names if you are willing,
Mhm.
and I know that you gave a presentation to a subcommittee to the Senate
Mhm.
about this. You are often called in, even when we were talking last night, you get called in to be on the witness stand for all
Yep,
kinds of things.
sure.
Who are you most concerned about right now? And what are the things have we not talked about that you wanna mention before we wrap? Because we haven't named any names, and I do know that there's some insurance companies that you're very worried about. some groups that you are worried about. And I even, because I've done my research, you've reached out to many insurance commissioners, and
I have.
have you heard back from anyone?
Not once. I have sent numerous letters via certified return receipt, so I know they got the letters, and every time I'm a professional, I say, "Please reach out and let's discuss it." Not once have they even acknowledged they received my letter, much less wanna talk it.
We've helped people unlock millions of dollars in hidden value just by reviewing their old life insurance policies. Unfortunately, thousands of people do not have life insurance policies set up properly, which could be costing them a lot of money. If you have a policy, the few minutes it takes to fill out our form could be the difference between continuing to waste money or unlocking serious value. If you qualify, we'll review your policy 100% for free and give you the honest breakdown you deserve. Click the link in the description or take comment below to apply. Back to the video.
Could people that are watching this, could they send this episode or reach out? I don't want to like poke the bear, but is it one of those things to say like, hey, have made, because would you talk to any insurance commissioner out of any 51 states? If they reached out to you, you would have a meeting with them
Oh,
and you would share the information.
totally fair and open, and
And you have the
I have
details.
the data already sworn to by the company. There's no magic that I'm doing.
And you would help them. You would give them that data.
I would tell them exactly what
Okay.
worries me
Okay.
and ask if I can be part of the solution.
I very much hope that you get 51 reach outs. I think
hope
people
so,
would,
too.
I think people would be out of their mind by at least not getting the data.
Right.
But let's start naming some names and breaking down. I don't know if you want to talk about this first or talk more, but you're actually going to share a presentation that you gave very recently to
Sure.
the Senate.
Let's
subcommittee.
talk generally first
Okay.
about groups of companies. We talked about fraternals and mutuals.
Yes.
Then separate from those, you have entities that are for-profit, and they often reward investors. So money has to come out of the
Yep.
pot, so to speak. But in the last decade or so, there's been a major move for private equity groups
Yes.
to take control of these life and annuity carriers, to purchase them outright. And from the moment they take control of that company, they control every aspect. And it's from day one, it's understood that if Apollo purchases an insurance company called Athene Annuity and Life in Iowa, when they close on that transaction, it's already in place that Apollo will be the investment manager for the company. So policyholders don't have a say in what's invested. But sadly, even the executives of the life insurance company itself don't have much say. The people that ultimately control what's invested in is the holding company, the parent. And I've been wanting to say this publicly for a while. I remember when I studied about private equity a long time ago, the reason they don't have to be regulated and they don't have to file all these kind of things that other companies have to file with the SEC is because they have to prove that the people that are in the private equity group are very knowledgeable and have their own money. Private equity. And so and their argument was generally, we got a bunch of money. It's our money. We're not risking others' money. We're risking our money. So, and we know what we're doing. So the SEC agreed to not regulate them at the same level. But when private equity first took control of an insurance company, I thought, oh my God, this could be trouble. Because now private equity groups that typically they're much more interested in profits.
Yeah.
Short-term, inflated values, things like that. They are not naturally going to look after the policyholders. And so when they took control of an industry, it really worried me. And it's turned out to be, I had a right to worry. Because I have to say that while there are very aggressive, high-risk, for-profit companies, publicly traded. The private equity groups that now control life insurers seem to have taken everything to an extreme. So over the last 5 years, all of the red flags I've been worried about for a while have surged. So that beginning about 3 years ago, it started to get pretty steep, increase in high risk. But in the last year, 2025 was a bad year. Companies took a lot more risk, had a lot less transparency, way more reinsurance offshore, a lot of secret activities going on. But also what I mentioned earlier, they're borrowing a lot of money short term. So the private equity companies tend to do more of that high risk, less transparent activity. But the for-profits that are not private equity controlled, they were doing some of this long before private equity got involved. So I can't give them,
But I see private equity as just an amplifier. Like they're going to speed up the process.
they sped it up in a big way. So, and I truly don't intend to target any particular company. I do the exact same analysis on every carrier.
And there's how many? 800?
Roughly 700 carriers, life and annuity.
700 carriers in the United States.
That's right.
And you look at, is it fair to say you look at all of them?
I do look at all of them, but I do the real deep dive analysis on the carriers that tend to have the higher risk profiles.
Okay.
For a good reason. A lot of the smaller companies like the fraternals and some of the smaller mutuals, they are so traditional. They invest in U.S. Treasuries and IBM debentures. They don't go buy a bunch of private credit. So when private equity got involved, I started seeing the portfolios of investments change radically over a period of years. You see that the private equity group takes control of a company that had, like you said with Ohio National, they were a great company. These were companies that had real assets, but over time, the better, more liquid stuff like treasuries and tradable bonds disappeared and were replaced with much higher risk, far less liquid investments. So,
and is private credit a good example of that?
Private credit is a great example. It's just a subset of a bunch of troubled assets.
And we talked about the arm's length transaction from reinsurance, but this is also happening where these companies are taking over these companies, they love insurance companies because they're super liquid.
And they have a lot of assets.
Is it possible that they're reinvesting into their private credit that they benefit? How, like, you can't make this, like...
It's very disconcerting because if private equity is far less regulated and they put together stuff, let's just say they bundle things and call it an asset, they can cause the policyholders' premiums to invest in that thing. So they could take a bunch of the stuff they don't want anymore that maybe have been devalued. But if they can sell them to the insurance company at an inflated value, it stays at that value because something we haven't talked about is what I call mark to make believe.
Okay.
Truly, in 2008, when the big collapse hit, a lot of insurance companies owned residential mortgage-backed securities, which is what was a big piece of that collapse. So both GAAP, generally accepted accounting principles, and statutory accounting came up with a temporary rule that said, for now, if your executives will swear that they're going to hold these investments out to maturity, we're going to let you leave it at the higher of cost or market. So if the market values drop, we'll see that, but we won't make you write down to that. I call it mark to make believe. whatever the bond is worth at a given moment, that ought to be what its value is, because when it's time to pay claims, you got to be able to sell it, right?
That's correct.
So what's so frustrating to me is they can take the higher risk, less liquid stuff, push it down into the insurance company, and leave it at whatever value it's at. So you have to admit that's tempting. If I was a private equity executive and I was more interested in profits than policyholders, I'd be tempted, right?
And what you're saying, and maybe this is not what you're saying, but I'm trying to connect the dots here, is the policyholders without consenting are taking on more risk by definition.
Excellent
But
point.
but their upside is capped because
Right.
it's through insurance or annuities.
Mhm.
And so you take an private equity executive or company and they're saying, "Oh, this is perfect. We're looking at the insurance company as a fixed low-cost loan that we can use to create massive upside, and we don't necessarily have to share a ton in that, because let's say we have to, whether it's an annuity or life insurance, we just have to like cover what they would be getting on treasuries. Anything else we can profit, but then ultimately if these things go down, the insurance company goes down. Hence the policyholders don't get. So how is that legal? Because I understand where the reinsurance idea, I understand how that's possible. I mean, I
Mhm.
don't agree with it, but it's like I understand how that works. Are they then buying private credit through these reinsurance companies, or how are they legally able to take treasuries and AAA bonds and swap them out with private credit that has maybe higher upside but greater risk?
Remember, I started by saying the private equity group from day one is the investment manager. So Apollo in the case of Athene, KKR in the case of
And you're saying they're regulated differently than,
well,
because it's my understanding that there's really strict regulations on what you can invest in with an insurance company.
there are very strict rules
Yep.
that are being ignored.
Oh,
Yeah. There there are really good rules that limit, say, investments in your own affiliated paper for a really good reason. But the companies it's skyrocketing. I don't know why the state regulators aren't saying you've now far exceeded your limit. None of them are.
I want to get your take on AM Best and Comdex score. Just curious, like when we look at a lot of these insurance companies, a lot of them have pretty good AM Best ratings, pretty decent Comdex scores. How much does that matter to you in your seat when you look at companies, their books, and then you look at their their ratings?
That's a tough one. I mean, really, it's a tough question. There are good rating agencies, and I'm sure there are times they give good scores, good ratings. But I use the source document always. The only source document is that sworn statutory statement. I cannot reconcile from the ratings I'm seeing with the underlying financials that I know I can count on,
Yep.
right? And so I'm not sure. There have been articles recently about some of the rating agencies perhaps not doing an adequate job. I believe there have been instances where rating agencies, certain ones, have actually been paid to give a better rating than the company deserves. All I know is that I can't explain when a company has an A plus and I read their books, very deep dive risk analysis, and I see it as maybe a B plus at best. I don't know.
Okay.
I'm sorry, I
Yeah.
can't do more than that.
Yeah. You were explaining last night on how there's a lot of pressure because if they get downgraded, they might have assets or
Oh,
loans that get called, and
you have a
so
good memory.
I try. I try.
You're right. Part of the problem we're in today is that a lot of these groups, not the insurance company itself, but the affiliates or the holding company, have borrowed a lot of money from outside banks or wherever. So if they borrow money, the loans often contain loan covenants that say, if this happens, we can do this. And one of the things that is often a loan covenant is that if the insurance company, which is the cash cow of the group, right? If it gets downgraded below a certain level, they can call the loan. And so it might be that the ratings agencies are at a point now where even if they felt like they should downgrade, they might worry that it could trigger some trouble.
Yeah. Let's talk about the this presentation that you shared to the Senate subcommittee, and I also would love for you to just share some of the companies that are red flags in your books that you're seeing. And again, just this is not your I guess this is your opinion based on the data that they're giving you. So, and I also just want you to know that if you're watching this, we're going to have another time where we're going to go through many insurance companies, some that pretty much all the insurance companies that we
Interested in.
are interested in represent. That was probably the first thing that I did when I talked to you. I said,
That's right.
tell me about this, because I don't want to represent anything that's shady.
Good.
And so I just want you to know that whether we talk about all these companies or not, subscribe, follow, because we will be dropping an episode where we get into lots of companies and get your 30,000 foot overview, because it would take forever if we went in. But let's talk about some of the companies that are red flags right now that are making you worried.
And by the way, these particular slides were for the help committee, right, of the Senate. I've also presented to the Senate Banking Committee, chief counsel and staff. I gave oral and written testimony to the U.S. Department of Labor on these very same issues. I was invited to speak to them on these issues, right? So they are concerned. Again, I am not picking on any particular company. I'm using companies that have significant examples of red flags. It's just easier to use a company that has each and every flag. I hate to do that, but this is a company. Now, will the viewer be able to see this slide?
Yes, they'll be able to see the slide. And
excellent.
And we're talking about Athene in this example. And it's interesting, Tom, after we first spoke, I talked to a person randomly, and they were an agent, and they were talking, and they were looking into Athene, and they were leaning towards that. And all I told them is, I said, hey, I know they look really, really good on paper, but this is what, and I don't have any clue what ended up happening, but I want you to know that this company is not just some hobunk company that that there's a lot on this company.
It's one of the biggest producers of annuities in the U.S.
Yeah, I think it's very, very important that people listen to this. And if you're IMOs, if you know people that are representing this, like they not only need to understand what we're going to talk about, but they need to work with you, and we'll have a clear call to action how they can get in touch with you, because you have data that everyone should be aware of that is at least representing this or helping clients.
I always provide the source document on every assertion I make. If you look at this slide, you can see at the top, it's Athene Annuity and Life Company. It's their most recent annual statement. The year is 2025, so it's every year end, December 31. If you look at row 28, that's the total liabilities. Column 1 is current year, so that would be 2025. Column 2 is prior year. So at year-end 2024, you see that total liabilities were about $274 million.
Yes.
In 1 year, it went from 274 to more than $336 billion. in 1 year. That is a huge growth.
I hope the assets grow by just as much.
So if you look at line 38, that is the surplus buffer, $4.1 billion. And I've got to tell you that it is the most important number in any insurance company's annual statement. By the way, just for the record, Athene Annuities year-end 2025 annual statement, one statement, one company, is more than 9,600 pages.
Wow.
9,600. And I go through those pages, you know? So if you notice, if you do the math, if you divide surplus 4.1 by liabilities of 336.63, you're going to get 1.22%. Okay? 1.2% is the buffer for that much liability exposure. The national average at year-end 2025 was like 7.03%. So, and unfortunately, that 7.03 has been pulled down
Because
by
of
some of these larger companies having far less.
some of the bigger mutual companies are rock solid. What type of
Huge.
What are theirs?
20 billion, 25 billion. New York Life, I think, is around 25 billion in extra buffer.
Okay, so okay.
But more importantly, New York Life has zero of the reinsurance offshore with captives. So it's not just that they have way more surplus, they also have less red flags.
Yes.
Okay. So the fact that it's 1.2% against a national average of 7, but the more prudent traditional companies, New York Life, Teachers Insurance, the Guardian, another great mutual, the real mutuals have 15, 20, 25 billion, up as much as 20%
Surplus.
in surplus to liabilities. So at the top, I say razor thin for a reason. That's very little buffer, because if you think about it, for every asset that's on their books, if it has to be written down $1, that has to come out of surplus. So if you've got 300 billion in a lot of which is higher risk stuff, it takes very little write down to eat up that $4
Yes,
billion.
agreed.
You follow me on that?
I'm with you. One misstep is bad with these numbers.
Now, I have to beg everyone's patience with me here. This is complicated, but this is where I live. I literally live in Schedule S Part 3, Section 1, columns 9 and 14, and how they impact the balance sheet. This is, if you'll look where I have yellow highlighting, on the left at the upper, you'll see it says reinsurance ceded. That means transferred out of Athene annuity into someone else. Schedule S Part 1 is reinsurance assumed. So we get to see both. What are they assuming from others and what are they ceding to others? Here's what worries me about this particular reinsurance portfolio. If you'll look, the first couple of lines are affiliates, Athene Life of New York and Structured Annuity Re. Those are a couple of regular insurance companies, but it's getting close to $1 billion. The next group, all 4 contracts are with Athene Re USA 4 in Vermont. These are those secret captives, but even that's only $1.2 billion. So the first 2.2 is not too bad. But then look at the next section. If you'll look in column 4, name of company, all of those contracts are with the same company, Athene Annuity Re Limited, and they're offshore. They're in Bermuda.
Are all of them technically second, like different entities in itself?
No,
They're all the same.
It's the same company. They're just different blocks of business they've reinsured. Okay. So that section totals to $110.3 billion.
Oh my goodness.
In modified coinsurance, ModCo they call it. But then look, if you go to the bottom, what company do you see there? Same Athene Annuity Re-Limited. And look at that, $65.26 billion in column 9, just 2 contracts to $65 billion, and that's column 9, reserve credit taken. I want to explain that. It gives prior year and current year. Reserve credit taken current year is everything. That tells you how much has Athene Annuity subtracted from its liabilities because someone else is on the hook. Remember earlier I gave the example in a legitimate deal, you can subtract the 10 because the other company is going to set up the 10.
Correct.
Here, they've subtracted 65.25 billion just with this group, but we don't know what's on the other end. We don't know if there's 65.25 billion to cover that. But then look, you've got more Modco, again, 5.7 billion. This one page, they have 66.5 billion in reserve credit and 116 in Modco, all with their affiliates. Okay, but
And is it fair to say we don't know what's actually happening on there's no transparency with over $100 billion in this scenario. We have no idea how many assets they have, what it's invested in.
all we can, because this company's in Bermuda, we can get a GAAP statement, a consolidated, which does not tell you what you need to know. If you're an insurance policyholder, you need to know what Athene Annuity, how it stands on a standalone basis. And so when all of this is moved to this offshore entity, why don't the regulators require, remember, this is an affiliate. So Athene in Iowa is affiliated with Athene in Bermuda. So why doesn't Athene Iowa, why doesn't the Iowa Insurance Commissioner say, look, just because you've moved the promises there, you still need to file an annual statement.
Yeah.
Why not file in the U.S. under statutory accounting? Because then we'd see
Everything.
everything. I guess they don't want us to see everything. But look, I conclude the Schedule S part with the totals. And I just want to point out one thing that I consider very significant. Notice that all combined, 168 billion in Modco and 67.5 in reserve credit. That totals to 242 billion. Okay, that's total ceded to any company. But look, 236 of that is all with their offshore affiliate. So 97.5% of their reinsurance is just internal. It's not to an outside party with its own money that files with the U.S. So,
And it's fair, even assuming I'm giving them the benefit of the doubt, even if they had dollar for dollar, which is most likely not happening here, but let's say it is, it still wouldn't be the idea of reinsurance is to spread your risk.
Spread
So
risk.
even if they're not accomplishing that by having 97% of their reinsurance their own
It's a
company.
excellent point, and it's a point I always make. It's not just that they have 97.5% with only one reinsurer, which is silly. Why not spread it? That's the whole idea. Traditional companies, New York Life, they have reinsurance with all kinds of real companies that they're not affiliated with. They have zero of this. So if you look at this, because you're not used to this, you might think, well, maybe that's what companies do. It's not. 97.5% of all of their reinsurance is not only with just one company, it's one company that is an affiliate, and that affiliate is offshore. It doesn't get much less transparent than that. Now, this is a really easy one. This will be a much easier pill to swallow. And I have been especially focused on this for a long time. Notice at the top, excessive level of affiliated investments. This is from something called the 5-year historical data, and it lets you see where a company stands from year to year. And I want you to note in column 5, that's year-end 2021, they had a little over $10 billion.
In reinsurance.
No, this is now investments in affiliates. You
Okay.
see investments in parent subsidiaries and affiliates. So this is paper like IOUs between brother and sister. Most of this would not be publicly traded. These are notes internal to the group. Okay. They went from 10 billion to 52 billion in just 4 years. 10 billion to 52 billion.
Help me understand what is this again? So you're saying notes in between companies, but is this private? Like, help me understand what that means again.
You can see they break it down. Affiliated bonds, 38.9 billion. They've only got 75 million in preferred stocks. A big chunk is line 48, all other.
Yeah. It seems like...
So between the bonds and the other and the mortgages, you've got most of it.
But is it affiliated bonds, like bonds in that own, like you're loaning your company money?
Certainly.
So it's like if my company wanted to write a bond to raise more money, it would, instead of me going out to the public market and getting it I'm just writing it and then I'm my own investor.
Well, you I guess only have one company. These groups have hundreds.
Just different.
So they could just have one of their affiliates issue a bond. They swap that piece of paper with the policyholders. Say, hey, here, we want you to buy this $2 billion affiliated investment. You have to pay us $2 billion in money, cash, or treasuries, something marketable, and we're going to give you a $2 billion IOU. And so the NAIC is really clear here. They don't want a company investing too much in affiliated paper because think about it from a common sense standpoint. In most of these groups, the insurance company is deemed to be the cash cow. It's generating all this money, and the money flows upward, right? So if these companies that now owe a bunch of money to the insurance company, if the insurance company got in trouble, if they had a run on the bank or whatever, and the insurance commissioner had to put them in receivership, remember how I said that freezes everything? How much do you think the public is going to think these IOUs from companies who are so dependent on the cash cow? Historically, the affiliated investments plummet deeper and faster
I believe that.
than bonds you could go out and sell in the marketplace.
Right.
So it's just common sense. We don't want you investing, they say, no more than 50% of surplus in affiliated investments. But if you do the math here, remember Athene has about $4 billion in surplus. 50% of that would be $2 billion, right?
Yep.
They have $52 billion. Doesn't that seem extreme to you?
Yes.
I mean, really, so think of how much more than surplus those IOUs are. And it's just reckless.
And that's not even counting the reinsurance shenanigans that they're doing. So it's like you get best of both worlds in this
That
scenario.
is so important. I'm proud of you for bringing that up because
I feel like we're a broken record, but I'm
no,
just so
you have to.
Yeah, it's disappointing that you're one of the only people talking about this. A lot of people are talking about private credit, which I would love to get your take on before we end. But I've until meeting you, have not heard anyone articulate this
at all.
And I have a show in the insurance space I get hit up with a lot of people wanting to come on the show. You're the first person that is able to articulate this.
Well, this is a no-brainer, in my opinion.
I agree.
You don't want to have what I've always called it since I was a young examiner is excessive interdependence
I agree.
within the group, because if you owe them and they owe you, what you end up with is circular capital, right? And so the point here is what you're raising is really important. We tend to look at this. So I'm saying, oh, they should have 2 billion, they have 52 billion. Think about how excessive that is relative to surplus. But you have to go back and all these other things I've expressed concern about, the reinsurance, all of these things stack up.
Yeah.
You have to add them up and then compare it to surplus.
Yeah, and you said this a couple of times. You don't want to be the person that's yelling fire in a movie theater kind of deal. But let's just play this out. Let's say hypothetically that Athene goes under. Okay, now they go under receivership, and now you would think, it goes back to what we talked earlier. They should have enough assets to cover everything, so everyone should be good. The problem is they got $52 billion of assets that now became a lot less valuable because everything's frozen
right away.
And so they can even, and then again, this is I'm playing both sides.
Sure.
They can say it's because the commissioners shut us down. They're taking something that was working, and now that $52 billion, like no one wants that. It's not like it's a bond out there that you can go sell. No one wants that because it's tied into a business. It's tied into a company or whatever you call it that's now frozen. And it doesn't take a rocket scientist to say no one in their right mind is going to be giving you $52 billion for those.
And that's what I meant when I said it's a no-brainer. This is excessive concentration of internal stuff relative to your surplus. It's just too much.
Okay, so we're going to try to end on a positive note here. Number one, with Athene, they're probably one of the worst. Am I fair to say that?
They are one of the highest risk in the country.
Okay, so they have pensions, annuities mainly, but some life insurance. What do you suggest if someone is selling or has annuities or part of a pension that Athene is backing? I know you need to be careful here, but it's like, what are some of the options that someone has if they're listening to this? And I don't want anyone to watch or listen to our show and freak out, so I'm going to try to end on a positive note here. What can someone do if they realize that they have an annuity or pension or a life insurance contract that is with a company that has numbers that they might not be thrilled about?
If you don't mind, let's first start with if an advisor approaches you to purchase something.
Okay. If
you don't already own the policy.
Yes.
Because that's a really sticky issue. But
I understand.
Let's say that an advisor says, hey, you should buy this Athene annuity. I would ask them, the policyholder should ask the advisor, I was told that they do a lot of offshore reinsurance and that it's not really transparent. Could you get for me, the policyholder, the total amount ceded offshore or to secret captives? We want to know how much reinsurance that's internal and compare that with surplus. And you could actually say line 38 from the balance sheet, right?
You sound really smart. Your advisor's going to look at you like
the advisor is not going to know the answer, but that's what's so important. The advisor would then have to reach out to the company, and the company would go, why are these agents asking this? And they'd start to realize that people care about what's in these financial statements.
I understand. Okay.
So if you haven't bought a policy yet and you're looking at it, I recommend that you go with companies that are transparent and don't take too much risk. That's just like they used to be. 3 decades ago, almost all of the companies were traditional.
Yep.
Right.
And thanks to your work, companies like ours or others will be able to actually show our prospects or people that are looking to us saying, "Hey, these are not only they're the ratings, but these are these based on Gober's,
Deep
I'm gonna say
dive.
deep dive because it's not even your numbers. It's just the
My
company."
my calling attention to see, this is a no-brainer. You
Yep.
don't want too much of this. These are the things I point out.
But the call to action, regardless if you're being approached, is you should be able to ask, and the advisor won't be able to tell you now, but they should be able to get that
You
information.
bet.
And if they can't get the information, that's a red flag.
Don't do business with them.
And if they can get the information,
If they have a bunch of offshore reinsurance
red flag.
relative to surplus, I would go to a company that doesn't have
Okay.
offshore. New York Life, Teachers Insurance, Guardian, they don't have
Yep.
any of the sham offshore reinsurance at
Yep.
all.
Yes.
Why would they?
Yep.
This is used for appearance sake,
Yep.
to free up more money for the top execs to do things with.
Yep. What would you say to someone that has a policy? It gets a lot,
Yeah.
and you got to be careful. You're not giving investment advice, insurance advice. I also don't. This podcast is for educational purposes only. So we're not giving advice. Period. Would be exactly what I would. This is what I asked you last night as
Sure.
well. So I'm
And
trying.
it's fair, and I can answer it. It's just a little tricky.
Yeah.
Because if you already own a product that has a withdrawal penalty, a lot of the annuities would have a penalty for taking it out prior to a certain number of years. I think you have to take that into account. If you're going to get hit with a 10% penalty for pulling
Yep.
out before a certain date,
Yep.
that's something you should consider. But frankly, I've had a lot of people tell me, and I believe it's true, if things start getting iffy, if there's something like a run on the bank, I think policyholders will say, I'd rather get 90% and take it rather than wait and get my 10% back and hope that I can get the other 90.
Yep.
So it's tricky.
It is tricky, and I think it's important for you to at least have the conversation, and look at pros and cons. And you may not be in a 10% penalty situation. You might, who knows? I think it's important for you to look at scenarios and say, if and do you have a prediction of when companies like Athene might have their full backs against the wall? Because it seems like they're operating just fine right now. How many years do you have a prediction?
I hate to say this, but 5 years ago, I was saying, I don't know if it can make it another 3 years. But it's not my analysis of the data that's faulty. It's the fact that the state regulators continue to allow them to do what I call pushing bad news into the future. If every year they from 2023 to 2024, they basically doubled in 1 year.
Yeah.
If you can just write up IOUs and sell them to policyholders, you can look good for a long time. They increased this, I showed you the reinsurance. It went from like 50 billion to 235 billion in 7 years,
Yep.
something like that. So all of these things are skyrocketing. So I can't predict. I think that it is a much greater likelihood today than it has been in the past. That's the best I can do. Sorry, man.
Okay. No. This has been great. And then outside of people asking their advisor and just understanding the numbers here, because we're focusing on the negatives, but there's a lot of insurance companies that are shining bright.
Fantastic
Shining
companies.
bright. You mentioned even Penn Mutual shining bright. There's other carriers that we'll go through in a separate video that we'll go through each one, and you'll kind of give your basic 30,000-foot overview. But that's important. Anything else that you want to say before we land the plane on this? And I can't thank you enough for
man.
sharing your story, breaking down, like, I don't know about, I bet most people, including myself, it's the first time that we're looking at documents like this.
You can bet. It's new.
And I'm grateful for people like you because you have a heart and you
I care.
from very beginning, you've been very consistent that you love this space. There's a huge need for annuities and life insurance companies, and they need to be doing the right thing because they're making lifelong promises. Any final words that you want to say, or any rays of hope? I know you have a
There's a lot of hope.
Okay.
There are a lot of large mutual insurance companies and a lot of fraternals. I moved
Yeah.
to where I live now because I went to present to this small fraternal. They had the lowest risk score in the
Yeah.
whole country, and I was so proud of them. I went and presented to them because I wanted the agents to know when they go to sell a policy, they can be confident
Yeah.
they're selling a product where the company's going to live longer than their client, right? There are great fraternals and mutuals, and they don't use any sleight of hand, reinsurance, pretend, creating fluff. So I know that I would not purchase a life or annuity product or a pension-related product from a private equity controlled or even a for-profit company.
Yeah.
Let me say this
I think
to
that's, I mean, yeah.
close. Let me say this. It is my professional opinion that investors do not need to reach into that pot
Yeah.
and take out money that policyholders paid in. Because if you think about it, what they're taking out, these investors or private equity, whomever, what they're taking out has to represent overpaid premiums. They've paid premiums that were greater than necessary to cover the claims. So remember, mutuals give that back. Isn't that what you're supposed to do? If you overpay, you get it back. Instead, someone's reaching in and taking that. And once you start that, you're headed down that slippery slope.
So it's your opinion that a mutual and fraternal is the beginning. You still need to look at what they're doing, but the
Still
beginning,
want to look.
stock companies and private equity backed companies are just there doesn't seem to be upside if you want to do an annuity, life insurance, or
I'm
pension.
just not comfortable with their business model.
Yeah. Tom, thank you.
Thanks for having me. I appreciate it.
If you're an advisor, life insurance agent, or someone who just loves the life insurance space, we have a must-attend event for you. It's our 5th annual Life Insurance Summit, June 15th through the 17th, right here in Nashville, Tennessee. Not only are we going to have the biggest names in the life insurance space, but this is also an incredible opportunity for you to meet and connect with like-minded individuals and be a part of our ever-growing community. Learn more and get your tickets before they sell out in the link in the description or pinned comment. Can't wait to see you there.